Imagine boosting the energy output of a solar farm by maybe up to 25%, just by adding a smart, pretty affordable piece of tech that follows the sun.
Yeah, it's pretty wild, right? That's the power of solar trackers.
And it's a key reason this tech is becoming so central to, well, renewables.
Exactly. And that's why we've been digging into Array Technologies, ticker ARRY. They're like the #2 player globally in this space.
Right, and they just put out some pretty interesting Q1 2025 results. So for this deep dive, using the reports and analysis you shared with us, our mission is really to cut through the noise.
Yeah, figure out what's really driving Array's performance and, the bigger industry trends that actually matter.
Okay.
Think of this as your express route to understanding Array Technologies. We're not just reading facts off a page.
Yeah.
We're pulling out the essential stuff. We'll look at their core business, the leadership, financials, how the market sees them.
Who owns them?
Who owns them? The risks, the opportunities. The goal is to give you a clear, structured picture based only on the info you provided, without getting lost in the weeds.
Got it. So our mission: dissect the key factors behind Array's recent success, the challenges they're up against, and what it all means. For solar, for potential investment thoughts, all based on your materials as of May 7th, 2025.
That sounds like a plan.
All right, let's get started. Let's understand the core business first. What exactly do Array Technologies do?
Okay, so at their heart, Array Technologies focuses on utility-scale solar projects. We're talking those massive solar farms you sometimes see.
The really big ones.
Yeah, and their main product is single-axis solar trackers. These aren't just static panels sitting there.
Right.
They're pretty sophisticated systems. They automatically pivot during the day to follow the sun's path.
And that tracking ability, that's where that big energy boost comes from, that up to 25%.
That's exactly it. It makes a real difference in the overall economics and profitability of a solar project.
And it's not just one kind of tracker they make, is it?
No, they have a whole portfolio, really, designed for different situations. Their main one, the flagship, is the DuraTrack, known for being reliable, good for large, flattish sites.
Okay.
Then there's the OmniTrack. That one's pretty interesting because it's designed for projects on uneven ground, hilly terrain.
Ah, more adaptable.
Exactly. And that adaptability is clearly hitting home with customers. It's something like 20% of their recent order book now.
Wow, okay.
They also have the STI H250. That's a dual-row tracker that came over with their acquisition of STI Norland, more geared towards international markets, sites with weird shapes.
It sounds like it's not just about the hardware, the metal bending and all that. Software seems pretty important too.
Absolutely. I mean, they have hardware systems like Skylink, which integrates things, but their SmartTrack software platform, that's a key differentiator.
How so?
Well, it uses data, algorithms, to optimize energy production in different ways. Like it has terrain adaptive backtracking, meaning it adjusts panel angles intelligently on slopes so they don't shade each other. Pretty clever. It also optimizes for diffuse light, like on cloudy days. It can trigger snow shedding.
Seriously?
Yeah, and even has a hail alert system to try and minimize damage. It's impressive stuff. SmartTrack is currently optimizing performance for over 5 gigawatts of solar capacity globally.
5 gigawatts, okay.
So yeah, it's this combination of robust hardware and intelligent software. That's the value proposition.
So zooming out a bit, who are the main customers buying these sophisticated sun tracking systems, and what's the bigger market look like?
Their main customers are the big players in utility-scale solar. So developers building the projects, IPPs, that's independent power producers who own and operate them, and EPC firms.
The construction guys.
Right, the engineering, procurement, construction companies doing the actual build-out. They basically operate in 2 main segments: Array Legacy, which is more U.S.-focused, and STI Operations, their international arm.
And the industry itself. Looks like it's growing fast.
Oh, yeah. Substantial growth. It's fueled by this whole global shift to renewables, right? Yeah. Climate change concerns, energy security. Plus, solar's just getting cheaper, often the most economical new electricity source.
And government policies must be playing a big role, too.
Huge role. Things like the U.S. Inflation Reduction Act, the IRA, massive catalyst. Tax credits, other support. These policies really shape demand. Plus, you've got tech advancements, bifacial panels, AI creeping in for optimization. That's all adding momentum.
So what kind of growth are we talking? What do the forecasts say for this tracker market?
The projections look pretty strong. The sources we looked at suggest the global solar tracker market could grow from, say, $10, $12 billion now
Okay.
to somewhere in the $21, $25 billion range by around 2030, maybe 2032. That's significant. And the expectation is trackers will actually grow faster than the overall solar market.
Interesting. Where's the growth happening?
Right now, North America is the biggest market, but Asia Pacific, Latin America, those areas look poised for really substantial growth too.
But it can't all be smooth sailing. There must be challenges, roadblocks.
Oh, for sure. Definitely headwinds. Supply chain issues are a big one, getting steel, semiconductors, raw material costs can swing wildly, logistics, finding skilled labor, that can be tough.
What else?
Grid interconnection. Just getting the power onto the grid can cause major delays. And then there's policy uncertainty, especially around tariffs, the future of things like the IRA.
You mentioned tariffs specifically.
Yeah, the recent U.S. tariffs on solar parts from Southeast Asia, that's created a lot of near-term uncertainty for the whole industry.
Okay, that brings us neatly to the competition. Who else is playing in this sandbox?
It's actually a fairly concentrated market. A few big global players dominate. Nextracker, ticker NXT, they're the current market leader.
Number one.
Right? Array Technologies consistently holds that number 2 spot globally. Then you've got others like Game Change Solar, PVH, Soltech, Arctech Solar, Trina Tracker, FTC Solar.
So a handful of key competitors.
Yeah, especially in the U.S. market, it's really Nextracker, Array, and Game Change that are the main contenders.
And what makes or breaks a company in this space? What are they competing on?
It's several things. Price, obviously, always matters. But reliability is huge. How well do these things work? How long do they last?
Right, bankability too, I imagine, for these huge projects.
Absolutely critical. Lenders need to trust the supplier is solid. There's ease of installation, how good the software is, their global reach, supply chain strength, and increasingly local content.
Local content, you mean like for the IRA rule?
Exactly. Being able to meet those requirements can unlock extra incentives. So there's this trend towards integrated solutions, hardware and software together. And honestly, the cost and tech know-how needed, it creates pretty high barriers for new companies trying to jump in.
Okay, let's focus on Array's specific advantages then. What's their competitive edge, their moat?
Good question. Let's break down their moat. First up, brand and reputation. Array's been around over 30 years. They've built this track record for reliable products. Their tagline is engineered simplicity. And with over 80 gigawatts installed or awarded worldwide, that gives them strong bankability. That's a huge asset when projects need financing.
Makes sense. What about technology? Patents?
Yep, that's another piece. They have a patent portfolio. They invest in innovation. OmniTrack, Smart Tracker examples. They recently put money into Swap Robotics for automated installation. Shows they're trying to stay ahead.
But innovation's fast everywhere in this industry, right?
It is. That's a key point. Things change quickly.
How about their costs? Manufacturing.
Their engineered simplicity idea is partly about lower lifetime cost, less maintenance, more reliability. Historically, they've had pretty strong gross margins, though we saw some pressure in Q1. A big advantage right now, though, is their diversified global supply chain and the fact they can offer 100% domestic content trackers. That hits the sweet spot for the IRA incentives in the U.S.
Are customers locked in? Or can they switch easily? What about suppliers?
For suppliers, switching costs seem pretty high. Array needs specialized parts. For customers, it's more moderate. There are other options, but changing suppliers means redesigns, different installation. It's a hassle. Array tries to build stickiness with long-term value, the software integration. That Swap Robotics investment might make switching trickier later, too.
Any network effects, like with the software?
Potentially. It's maybe early days, but with Smart Tracky, the more sites use it, the more data they get. That data can improve the algorithms for everyone. With over 5 gigawatts on the platform now, that could become a stronger advantage over time.
So summing up the moat.
I'd say brand, bankability, and their IRA domestic content position are the key strengths right now. But, they face pressure from big suppliers and big customers. And that recent margin dip, despite revenue growth, definitely something to keep an eye on.
Okay, let's shift gears to the people running the show. Who's leading Array? What's their track record look like?
The CEO is Kevin Hostetler. He started in April 2022. His background, mostly leading global industrial businesses, experience with operational improvements, M&A, international stuff.
It sounds relevant.
Yeah, especially with integrating STI Norland and managing a global footprint. His time at places like Rotork, FDH, Velostal seems
That's the team. And how much skin do they have in the game insider ownership?
The wider team brings experience across the board: ops, finance, strategy, sales, legal, all the key areas. We did see the CEO and COO buy some stock recently, which can be a positive sign. Just small amounts, though.
Okay.
Overall insider ownership is really low, like 0.3%. That's not much. So the alignment of management interests with common shareholders through direct ownership is pretty limited, something investors might want to consider.
Okay, now how does ARRY decide where to put its money? Capital allocation strategy.
Well, R&D is definitely a priority. See that with OmniTrack, SmartTracky, the SWAT robotics investment. They need to innovate to compete. M&A has also been key, obviously, with the big STI Norland deal back in January 2022. The idea was global expansion. Makes sense strategically, but the integration has been rough.
How so?
They've had accounting errors, needed financial restatements, found material weaknesses, and then took huge impairment charges on that deal in 2024. Hundreds of millions. It suggests they either paid too much or the synergies just aren't panning out. That raises questions about past capital decisions, frankly. It looks like shareholder value destruction.
Ouch. Okay, what about debt and shareholder returns?
Yeah, they carry a lot of debt,
Okay.
partly from STI, partly from their history with private equity, so high debt-to-equity ratio. On the plus side, they did manage to amend and extend their main credit line recently, which helps near-term flexibility. They also have convertible notes out there.
Dividends.
No dividends on the common stock. They're reinvesting earnings back into the business.
Yeah.
But, and this is important, Blackstone put in a lot of money via perpetual preferred stock back in 2021.
Preferred stock.
Yeah, and that comes with a hefty quarterly dividend obligation, around $14.4 million. That gets paid before any common shareholders see anything. So even though they've had positive free cash flow lately, the focus seems to be internal growth, managing debt, and paying that preferred dividend.
Let's talk about how they're actually running the business day to day. Operational effectiveness, handling crises.
Well, their recent Q1 2025 was definitely strong. Beat guidance, seemed to claw back some market share, and achieving record gross margins in FY24 even while revenue fell. That suggests some good cost control somewhere.
But they've had issues before.
Oh yeah, they have operational challenges back around 2015, 2018 that needed their owner at the time, Oaktree, to step in. And more recently, those STI integration problems, the accounting stuff, control weaknesses, that's a definite concern. Right now, they're navigating big external stuff like the tariff mess and potential IRA changes. How well they handle that will be key.
And finally, on management, transparency, ethics, any red flags from the info?
Generally, they seem to follow the usual public company rules. Reports, earnings calls, investor decks, it's all out there. They have anti-bribery policies too. However, those STI-related accounting errors and material weaknesses in 22 and early 23, that definitely hurt the reliability of their reporting for a while. It's something investors need to be aware of.
Okay, let's really dig into the financial health now. Looking at the numbers, can you walk us through their performance over the last 5 years or so?
Sure. So looking back from 2020 to 2024, revenue has been, well, volatile. Big growth spurt in 2022, then it pulled back in 23 and 24. The 5-year growth rate isn't super high, maybe around 7%.
Okay. What about profits?
GAAP gross profit margin actually shows a pretty decent upward trend overall, improved quite a bit in 23 and 24, hitting over 32% in FY24. But GAAP operating and net income, much more jumpy, mostly because of those huge STI impairment charges in 2024. That pushed them into a big net loss for the year.
But they adjust numbers too, right?
They do. Adjusted EPS for FY24 was $0.60, and a key positive. They started generating positive free cash flow in 2022 and kept it up through 2024, around $135 million last year. That's important for servicing debt.
And the most recent quarter, Q1 2025, what did that tell us?
Q1 was quite strong, as we mentioned. Revenue nearly doubled year over year, beat estimates. Adjusted EPS also beat forecasts. They shipped a lot more volume, up 143%, suggesting they might be regaining market share.
What about margins in Q1?
GAAP gross margin dipped compared to a really strong Q1 last year, down to about 25.3%. But they said that was kind of expected due to project mix. Adjusted was a bit higher at 26.5%. They actually reported a small GAAP net income. And importantly, their order backlog jumped sequentially to $2 billion.
$2 billion order book. And the market reacted positively.
Yeah, the stock price got a nice bump after the announcement.
So overall financial stability, what's the picture based on the data? Key ratios.
Okay, stability. They have a decent chunk of cash, about $348 million end of March. Total assets around $1.4 billion, liabilities $1.1 billion. But the big thing is the leverage.
The debt.
Yeah, total debt is around $680 million.
Yeah.
And because of past losses and that preferred stock, their common equity is actually negative. Negative book value per share. High debt to equity.
What about returns, ROIC?
Adjusted return on invested capital looks like it's hovering somewhere around 8.8% to 9.5%. Their estimated cost of capital is maybe in the 7% to 9.6% range. So ROIC is potentially close to or maybe even below their cost of capital. Suggests they might not be creating a ton of economic value right now.
Okay, liquidity, short-term health.
Liquidity looks better. Current ratio is healthy. Quick ratio too. They extended that credit line, and they are generating positive free cash flow. So they seem okay for near-term obligations.
Let's circle back to profitability and margins.
Right. GAAP gross margin improved nicely in 23 and 24.
Sure.
Then that dip in Q1 25 due to mix. GAAP operating and net margins in 24 were totally skewed by the STI write-downs, like a negative 32% net margin. Just awful on paper.
But the adjusted numbers.
Yeah, adjusted EBITDA margin gives a different view. Around 19% for FY24, about 13.4% in Q1 25. That looks more favorable compared to peers, suggests that the core operation might be profitable. But you can't just ignore those GAAP losses. They reflect real economic hits.
Understood. Lastly, what are they telling the market to expect for the rest of 2025? The guidance.
They reaffirmed their full-year guidance, expecting revenue between $1.05 and $1.15 billion, called $1.1 billion midpoint, about 20% growth. Adjusted EBITDA, $180 to $200 million, midpoint $190 million, maybe 9.5% growth. And adjusted EPS, $0.60 to $0.70, midpoint $0.65, about 8.5% growth.
Does that include the IRA benefits?
Yes, it incorporates the expected boost from IRA Section 45X manufacturing credits. And importantly, they reaffirmed this guidance despite all the market headwinds, tariffs, IRA uncertainty, maybe flat U.S. installations.
It smells confidence.
Seems like it. Probably banking on that strong order book, market share gains, managing their supply chain. But notice something.
What's that?
The guided growth for EBITDA and EPS is lagging behind the revenue growth. That suggests they might be expecting some ongoing pressure on profit margins this year.
Interesting point. Okay, so we have a good handle on the business, management, financials. Let's look at how the market feels about ARRY, analysts' sentiment.
Overall, it seems cautiously optimistic. Most analysts covering the stock have buy or equivalent ratings. Guggenheim, Barclays, Jefferies, Truist, UBS, Oppenheimer.
But not everyone.
No, there are some neutrals or holds too. Susquehanna, Mizuho, Seaport Global, RBC Capital. And the price targets, they're all over the place. Really wide range.
What's the average or median target saying?
Median seems to be around $8 to $8.50, compared to the current price around $5.50. That suggests significant potential upside if they hit those targets. But some analysts have trimmed targets recently. Worries about sales, profits, competition. The commentary acknowledges the Q1 strength, the guidance, that domestic content edge. But they keep highlighting the concerns: margins, competition, policy risks.
Makes sense. What about other market signals? Short interest, options.
Short interest is persistently high, really high, like 14–15% of the float shorted. Takes maybe 5 days to cover.
Meaning lots of bets against the stock.
Yep, exactly. Indicates significant market skepticism, probably driven by all the things we've discussed: high debt, tough competition, policy worries, the stock's own volatility.
Does high short interest mean anything else?
Well, it creates potential for big price swings. If good news hits, you could get a short squeeze, driving the price up fast. But bad news could amplify the downside. Options activity. Near-term data showed maybe slightly more interest in $5 calls than puts. Could be speculation, could be hedging. Hard to say definitively.
Okay, let's peek under the hood at who actually owns ARRY, the ownership structure.
Institutional ownership is very high. Probably over 90% held by funds, big investors. Yeah. Looking at recent filings like Q4 2024, it was mixed. Some funds bought more, some sold down or got out completely.
And insiders. Management.
As we said, very low, around 0.3%. Those small recent buys by the CEO, OEO, are noted. But overall, there's just not much direct alignment between management and common shareholders via stock ownership.
Right. Okay, let's try to pull all this together now. A risk assessment. Strengths, weaknesses, opportunities, threats, the SWOT analysis.
All right, SWOT time. Strength. Established brand, 30-plus years, good track record, bankability, leading market position, #2 globally. Innovative products, OmniTrack, SmartTrack, that strong $2 billion order book, big IRA leverage in the U.S. with domestic content, experience management, generating positive free cash flow recently. That's a solid list.
Okay, now the flip side, weaknesses.
Top of the list. High financial leverage, that big debt load. History of GAAP losses, those STI impairments were huge. Past internal control issues, restatements, revenue volatility, very low insider ownership. And that Q1 margin compression is a recent weak spot.
Got it. Opportunities, where can they win?
Huge opportunity in the overall solar market growth, obviously. Potential to expand more internationally, leveraging STI. Trackers are gaining share versus fixed systems. Their smart track software and services offer growth. Really leaning into those IRA domestic bonuses. Maybe increased electricity demand from data centers helps. And internally, potential to cut costs more, finally realize those STI synergies.
And finally, the threats. What keeps them up at night?
Intense competition, definitely. Pricing pressure.
Yeah.
Policy and regulatory risk is huge IRA changes.
Right.
Tariffs. That's a major cloud. Input cost steal especially. Logistics. Supply chain disruptions are always a risk. Customer project delays if their customers stumble with permits, grid connection, financing. That hits Array's revenue. Tech obsolescence, falling behind. And that high debt makes them vulnerable to interest rate hikes or economic downturns.
Let's drill down on those 2025 U.S. tariffs again. What's the specific risk there?
Okay, so the Commerce Department made its call on potential duties for solar cells modules from Southeast Asia. The big question now is the U.S. International Trade Commission, the USITC.
What are they deciding?
Whether U.S. manufacturers were actually injured by those imports. If they say yes, we could see high tariffs kick in. That could seriously increase panel costs. Could slow down solar deployment, mess up supply chains. It might help domestic panel makers, but for Array, it's tricky. Their domestic trackers help customers get IRA bonuses, which is good. But if overall project costs soar because of panels, demand for everything, including trackers, could drop.
So is it a double-edged sword?
Kind of. Management admitted the uncertainty is making some customers pause. They did say about 75% of the remaining 25 domestic deliveries are sort of de-risked using domestic panels or panels already landed. So near-term management looks okay. Long-term. That depends entirely on those final tariff decisions and how competitive U.S. panels become.
Okay. Wow. So after this really comprehensive deep dive, business, leadership, financials, market view, risks, opportunities, let's try to boil it down. Key takeaways.
Yes, summarizing. Array is clearly a major player in a growing, important market, solar trackers. They've got recent positive momentum. Q1 was strong. They have real strategic advantages, especially with the IRA in the U.S. However, there's always a however. There is. They're operating with significant financial leverage, lots of debt. They face a really complex, uncertain external environment competition, policy risks. And that STI acquisition and its fallout, that still casts a shadow. So the overall picture, it's multifaceted, there's potential, but there are very real risks and uncertainties.
Which brings us to the big question, really, for you listening. Given all this volatility in solar and Array's significant debt load, is that potential upside that some analysts see, is it really worth the considerable risks involved?
Or perhaps are there some less obvious vulnerabilities hidden within this outlook, things that warrant your further careful investigation?
Something to really mull over.
Definitely. And if you found this detailed analysis useful, we'd certainly encourage you to subscribe to the Stock Analytics AI YouTube channel. We do more deep dives like this regularly.
Absolutely. And just our standard reminder, everything we discussed today is purely for informational purposes. It is absolutely not financial advice. Please do your own research.
And we should also acknowledge that AI was used to help with the research and summarization process for this discussion.
Okay. Thank you so much for joining us for this deep dive into Array technologies. Please remember, our analysis is based on the information publicly available as of May 7th, 2025. We really hope you continue your own thorough research and critical thinking.
The energy transition is full of promise, no doubt. But as always, the devil is in the details, especially when you're trying to figure out that risk-reward balance.